Alphabet, the parent company of Google, just saw its stock soar nearly 7% after hours. And that's because of a new decision in the Google search monopoly case that just came out. This monopoly case has been looming over Google stock for nearly a year, and now the stock will be opening tomorrow morning at record highs. The current share price is $226 after hours. If you've been following the channel, you know that Google stock has been my #1 buy of 2025. This year I bought over $25,000 worth of Google stock, with the overwhelming majority being purchased in that tariff sell-off. Since then, Alphabet has rebounded up back to all-time highs and is set to continue growing from here. This is now the 4th largest position in my long-term dividend growth stock portfolio. It's on its way to being the 3rd. This is 12.9% of that account, and I look forward to it being a core position for many, many years to come. Prior to this latest increase, I already had a 30% total return on Alphabet stock, and I think this definitely was my best buy of 2025. That April tariff sell-off was a huge opportunity to load up on Alphabet stock at very attractive prices. So today I'm going to break down that monopoly case and explain why Alphabet stock went up after the news came out. I'll be sharing both the positive and negative outcomes. And finally, I'll give a brief updated stock analysis on Google. I'll give my thoughts about whether it's a buy right now and at what prices I would be buying more Google stock. With that said, let's roll the intro and get into this Google stock update. My name is Zach. This is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. If you want to use the same tool I'm using throughout the video, it's available at dividenddata.com. The link is in the description and pinned comment of the video. All right, so before I give you my update analysis on Google, let's dive into that monopoly case, which is why the stock is surging after hours. I asked the AI analyst on dividenddata.com to give me a breakdown of the search monopoly case and the outcomes, both positive and negative. All right, so what just happened? A federal court ruled on the Google search monopoly case, and they ruled that Google violated antitrust laws to obtain a monopoly in the online search market. So you might see that and say, how is this good for Google? Well, the details matter. Right now, it seems extremely likely that Google will not be broken up and forced to divest any of their businesses. The judge did not order Google to divest from its Chrome browser, which was a big talking point, as well as their Android operating system, which gives them huge distribution for Google search on all of those Android phones, which is a lot of market share. So that's massive for Alphabet. So what they have to give up? Well, Google is expected to lose exclusivity contracts. So as an example, they can't make a deal with Apple to be the exclusive search provider on their phones. So just as an example here, Apple could do deals with other companies. You're already seeing that being done with ChatGPT in the AI space. The company is also required to share certain search data with their competitors to prevent exclusionary behavior. All right, so let's look at the positives and negatives. The positives, they don't have to divest their businesses. They get to keep that whole Google flywheel they've been building up for years intact. Chrome and Android don't make much money themselves, but they're part of the distribution of Google search. They just want as many people using their products and services as possible. They make it back on the usage of their products via ads. Let's not forget that Google's primary revenue source is Google search ads. That's the core cash cow profit driver of the company. And we'll talk about that more as we get into the stock analysis part. So Google gets to keep the Chrome browser and the Android operating system. They also get to continue their search distribution deals with companies like Apple and Samsung. Those are worth billions of dollars. This is where Google pays Apple money in order to have their Safari browser default to Google search. And they're willing to do that because they make that money back in the advertising on Google search. And as we go back through the history of Google, these kinds of distribution deals were a huge growth driver for them and allowed them to become the dominant search platform. I'm talking all the way back to the late 90s, early 2000s, making deals with companies like Yahoo in order to be their search engine. So if they weren't allowed to continue doing these deals, that could have been a problem for their business. So the fact they can continue doing deals like this is important. Now, if we look at the negatives, they can't have exclusive contracts. I was looking for some examples of these exclusive contracts, and we have the Apple deal I mentioned. We have Mozilla with Firefox. We have Samsung with their phones. But from what I've read online, what my AI says, and CNBC interviews I was listening to with former DOJ officials, they were very clear that Google will be able to continue their search distribution deals with Apple and Samsung. So I don't know if this whole exclusivity thing is really just trying to pave the way to allow these companies to do more deals with smaller companies, and they're probably just trying to promote competition with AI search, which is already naturally happening in the market. If you have better examples of contracts that wouldn't be allowed, please leave a comment below in the YouTube comments. And then the other big negative is that by losing exclusivity and sharing search data with competitors, Google will slowly face more increased competition in the search market. Now, in my opinion, I would say that was already happening whether this antitrust case happened at all. The search market is more competitive right now than it has been in decades, and that's due to the disruption around AI search and answers. But we'll talk about that more in a little bit. Overall, the market's looking at this result as a win for Google stock. And I definitely would say it is too, because they avoided the worst possible outcome of Google being broken up. And that's why Alphabet stock is up 7% after hours. So should you buy Google stock right now after this news and less uncertainty around it? In my opinion, I would say no. You should have been buying it over the past 6 months when it was at a much better value. That's what I was doing, and I was making plenty of videos about it on the channel. That said, I would say Google stock is still in the fairly valued range, even after rising after hours. And over the long term, this business is a compounder in the market that should be growing earnings at a high rate. As you can see, the company has grown their earnings per share significantly over time, and in 2025 has been hitting all-time highs. Based on earnings per share over the trailing 12 months, they currently trade at a 22 P ratio, and analysts are projecting double-digit earnings per share growth and revenue growth in the coming years. This will give them 2029 earnings per share of $16.13, which at today's stock price would be a 13.1 P ratio. So Alphabet stock still trades at a very reasonable valuation for being one of the best companies in the history of the world, and one of the best big tech companies today, and one of the leaders in AI. AI is a little bit of a double-edged sword for Google. In one way, it creates a lot of new competitors in AI-powered search, whether it's ChatGPT, Perplexity, Grok, Claude, whatever you want to use. There's a lot of new entrants in that space, and in some ways, we're moving away from search to answers. And the monetization for that is still unknown in some ways, whether that will be an ad-based thing that's free, like search, or a subscription-based product that you have to pay for. But Google has the talent, the money, the infrastructure to be able to invest and be a leader in AI. They already have some of the leading models, and I think they'll be able to compete both on that consumer, free, fast experience, which is what the AI search market will likely be. And I think long-term, that will likely be an ad-based business model. And there's no company better equipped to monetize that than Google. They already have the largest digital advertising network around search. I think the narrative around Google search dying is extremely overrated and is not showing up at all in the financials right now. And if you have just been using Google and you see the AI overviews and the new AI mode, all of this stuff is being integrated into search and making it an even better product experience. So on the consumer and ad side of AI, I think Google is in a very strong position, but they're also one of the only companies that has the ability to compete on that high end of AI where they're racing towards super intelligence. There really are only a few competitors in that race, and who knows the potential bull case that could be done with that. Frankly, I don't think we're really pricing that in as a potential outcome with Alphabet stock, which for investors, that's good. So overall, I feel confident that Alphabet will continue compounding over the long term. And let's just take a quick look at their historic financials to see what a great business this has been. Revenue per share has been growing at a 19.2% 10-year compound annual growth rate. Net income per share has grown at a 22.7% 10-year CAGR. Free cash flow per share has grown at a 21% 10-year compound annual growth rate. Although that has slowed down a bit in recent years due to all of the CapEx investment from these AI data centers. But you guys know what I think. I've been talking about this with both Microsoft and Google. They have to be investing in this AI infrastructure because the bigger risk is being disrupted and not being the leader in AI. That's the bigger risk than spending a couple extra $10 billion for these kind of companies. Microsoft and Alphabet generate hundreds of billions of dollars. This is a very intelligent use of capital for them. The balance sheet for Alphabet is fantastic. Their shareholder equity has continued growing over time. It's actually been accelerating in recent years. Currently, it sits at $362.9 billion. This company has been very cash rich for a long time because they just rake in cash. They're very high margin. And they didn't pay a dividend for a long time, although they have started to. Hence why they have entered a spot in my dividend growth portfolio. I also own a little bit of Google stock in my Roth IRA. Currently, they have $95.1 billion in cash and short-term investments, and the financial position of this company is fantastic. They have negative $53.4 billion of net debt, and they do return capital to shareholders. As I mentioned, they started paying a dividend, and they had their first dividend increase of 5%. This is a very low payout ratio, below 10%. And they also do buy back stock pretty aggressively in recent years. In fiscal 2024, they bought back 2.16% of their shares outstanding. That is another way they return capital to shareholders. So overall, I feel very confident with Alphabet being a core position of mine well into the future. But am I buying more Google stock right now? No, I already loaded up a big position earlier this year at much more attractive prices. However, this is a company that I should be forcing myself to dollar cost average in as it grows over time. So personally, I'll be adding to my Google stock in the low 200s, high 180s, 190s, but that number will gradually shift over time as the business continues to grow. Overall, I feel very comfortable with my stake in Alphabet. I look forward to owning it for many, many years to come. I know many of our community members own Google stock as well. So a lot of you guys are excited that it went up 7% after hours, but I would just give you a little word of caution. Think long term. Don't get euphoric and think you missed the opportunity to buy it. There will be opportunities again. And with Alphabet, you also have to remember its primary revenue source is advertising, and that can be volatile in economic recessions. As an example, in 2022, they saw a decline in their earnings per share. So that kind of thing could happen again. We're not going to never have a recession. With that said, I hope you enjoyed the video. Leave a like and subscribe to the channel if you want to see more future updates. And if you want to use the research tool I showed throughout, it's all available at dividenddata.com. The link is in the description and pinned comment of the video. Thanks for watching, and I'll see you in the next one.